Morning, guys. Thanks everyone for joining us for the local balance fund presentation. I'm the Chief Investment Officer at High Street. My name is Ross Beckley. On my left-hand side, I have Chris Brownlee. He is the Head Research Analyst on the local balance fund. And to my right, I have Ross Yammin, who is Head of Research. So today we're going to be going over the performance of 2022, as well as our outlook for the year ahead. It's been a pleasing start to the year, but we do acknowledge that we have a long way to go to catch up some lost ground of last year. The agenda is going to cover a performance review. Generally, it was a very good year for South African markets last year, edging out a positive return. However, international markets fared a lot worse in face of heightened interest rate hikes, which we saw during the year. We'll go through this later. There's a lot to uncover here, but basically rising rates were very negative for growth-focused shares, to which the fund has a pretty large bias. We'll then move pretty quickly through the macroeconomic environment slides. Chris will be covering those. However, we are aware that a few of you have heard these before. So we will be pretty brief but concise at the same time when we go through those. Okay, moving on to the performance of last year. As mentioned, the JSE performed very well, up 4%. It was pretty broad across all sectors, with residential, with retail, industrials, and financials, and the resources all performing relatively in line. It was a very different story for global markets, with the MSCI index down 12%, the S&P 500 down 12.4% in Rand terms, and the developed property index down 19.9%. So we had a very positive year from the JSE. However, we do feel that the JSE was still playing catch up from the drawdowns that we saw following COVID, whereas the rest of the world rebounded strongly and quickly. We'll detail later how we still believe that offshore and Rand hedge counters are the place to be invested, and we do see more potential upside here. Property, we'll discuss more later, is very much correlated to inflation rates and GDP over the longer term, and the unprecedented interest rate hikes hit valuations in the short term, but we do see them recovering, and we have seen them recover to a certain extent. The large market losses seen in international markets saw a very strong dollar. We can see the Rand weakened by 6.4% relative to the US dollar, but against other major currencies, it held up quite nicely. So it was really a story of the strong dollar with people seeking a safe haven. If we go to the fund performance, the fund was launched towards the back end of 2018. And when we attained our 3-year track record, And when we attained our 3-year track record, we were the best performing fund in category, or second best performing fund in category. Last year was very poor performance, with the fund down some 23.6% relative to the benchmark, which was relatively flat. The fund's aim is to maximize offshore exposure, and therefore performed poorly in line with offshore markets, whereas the local market was quite strong, and this was predominantly driven by the SA-focused shares. We'll just like to reassure investors that we do see a lot of potential at these levels, which we'll cover in due course, and we have got off to the year off to a strong start as we aim to close that gap. Onto the performance attribution. As mentioned, the Rand hedge locally listed shares performed relatively well, whereas the offshore equity performed poorly. There was a 16.2% drawdown for impact on the fund, and that was for an approximate 40% offshore exposure. So the drawdown was significant in that equity component at some 40 to 45%. The Rand hedge property counters also performed very poorly, in line and worse than offshore property index. The property index due to the liquidity of those shares. I will now pass on to Chris Brownlee on my left, who will cover the equity, what led to the equity performance.
As Ross mentioned, our offshore equity component was the biggest detractor to the fund in 2022. And this was due to the large sell-off in offshore equities that we saw, and in particularly in growth equities in the US, in which the fund is invested. The fund does have, or the offshore component of the fund does have a growth bias, which we believe is suitable due to the fact that the local or Rand hedge equity component is more value orientated and defensive in nature, in addition to us seeing higher potential in select US growth names. Just looking at the chart, you can see that growth, proxied by the MSCI World Growth Index, has historically outperformed value, proxied by the MSCI World Value Index, over the last 10 years or so. However, in 2022, growth saw a sharp decline, falling 29%, while value fell just 6%. Interestingly, this 23% or so differential is value's largest outperformance of growth in over 20 years, dating back to the dot-com bubble in 2000, which I think speaks to just how drastic this sell-off in growth has been. This all came on the back of rampant global inflation and the US Fed and other reserve banks' aggressive rate hiking regimes, which came in response. As you can see, inflation, or US inflation, shown by the orange line there, really ramped up in the years 2021 to 2022, and then the interest rates followed at a similar rate, just with a lag effect. Obviously, this isn't good for equity and doesn't bode well for the equity environment, particularly growth equities, which is why we saw the sell-off in growth in 2022. Encouragingly, inflation does seem to have peaked in the US and is now coming down, and interest rates are expected to peak towards the back end of 2023 and come down from there, which is more encouraging for the overall and growth equity environment. Just speaking to how aggressive the Fed has been, this current rate hiking cycle is the most rapid in recent history. Looking at the graph, you can see that in the current cycle, which started in 2022, it took the Fed just 2 months to increase rates by 2%, whereas in the next fastest cycle in 1988, it took 8 months for the Feds to increase rates by the same amount. Additionally, looking at the 2004 cycle, it took 23 months for the Fed to increase rates by 4%, whereas it took just 7 months in the current cycle to increase by the same amount. So just speaking to how unprecedented the speed of the current rate hiking has been, and obviously this has had drastic effects on the equity markets. So going forward, are these rising interest rates a major concern? Yes, we have seen they have hurt valuations, equity valuations in the short term, particularly in growth equities, which we saw in 2022. However, our research indicates that although there is short-term valuation loss, the market returns following a rate hiking cycle are not necessarily low. In addition, in the ensuing recovery, growth has historically outperformed value. Looking at the chart on the left, we have taken the average performance during and following the last 8 rate hiking cycles, dating back to 1971. As you can see, the growth-heavy NASDAQ has outperformed the S&P 500 index in the periods following on a 1, 3, and 5-year basis. Just to add to this, while we acknowledge that the macro environment is important, over the long term, we do believe that fundamentals is what drives share price performance. We therefore focus more on picking companies with solid fundamentals, durable competitive advantages, which can endure through the various macroeconomic environments. Just expanding on this point, this is a slide from the recent Capital Group presentation and speaks to the premise of how market returns are indeed driven by fundamentals. You can see here of developed market returns, 70% or roughly 70% is driven by company-specific factors, which we take to mean as company fundamentals. So just supporting the fact that in the long run, a large amount of share performance is driven by fundamentals. From now, I'll hand over to Ross Yammin to talk through the fund's property performance.
Thanks, Chris. In property markets, we saw a very similar story to what we saw from global equity markets in 2022, that being that South African listed property stocks quite vastly outperformed developed market property stocks. In a similar way to how we are positioned within our equity component, we try our best to invest in listed property companies who make most of their revenue in hard currencies. And so the high street property basket is to a far greater extent linked to the developed market property index than it is to South African listed properties. Just to speak to a little bit more of the underperformance of the high street basket in 2022 compared to that developed market property index, is a lot of that is related to currency of our basket. The vast majority of that of those companies make their monies in pounds, euros, and Canadian dollars. And all three of those currencies had a really poor 2022 when compared to the US dollar. If we can go to the next one, please, Ross. In 2022, what we saw from our property basket was a big dislocation between fundamentals and between the share price performance of the stocks. What we are trying to do is to buy property companies who have robust rental income growth, whilst also having really strong balance sheets so that they don't run into any financial strife. In 2022, we saw the rent per square across our basket increase. Occupancy rates stayed relatively flat, while rental collection rates also stayed relatively flat. So our companies continue to grow their rental income in a robust manner. Also, if we look at the weighted average of our property basket's balance sheets, they have a loan to value of less than 33%. It costs them less than 2.6% on their debt. More than 90% of their debt is fixed, and so this dramatic increase in rates, which Chris spoke to, shouldn't affect these companies to too great an extent, and they have a weighted average maturity of more than 3.5 years.
Yeah, so, if I could just jump in there. I think what that ties very much in line with what I was saying at the beginning of the presentation. In the short term, these share prices are correlated to interest rate movements, negatively correlated. But in the longer term, it all depends if they can push top line rental increases through to their customers. And to your point, we target companies that have a fixed debt structure for a certain maturity that are able to grow that top line. So it's actually very beneficial for these property companies. High levels of inflation and interest rates aren't really a concern.
Yeah, interest rates aren't really a concern. And in our screening process, when we are selecting these stocks, we look at the balance sheet and their historical rental income growth very, very closely. And at the moment, we're very happy with our composition of our property basket. I think it's also important to look to history as a guide. We've seen 2022 was a very difficult year. Similarly, in 2020, following all the disruptions that COVID made to markets around the world, we saw a drastic drawdown within listed property markets. In the 2020 period, we had a drawdown within our basket of nearly 50%, with the index seeing a drawdown of 43.1%. What was encouraging, though, is due to the slightly lower liquidity of our property stocks and being slightly smaller cap securities, as we saw a very fast rebound to make up those losses from our basket. Our basket managed to recover the losses in 8.6 months, and that's compared to the index of 17.1 months. In 2022, again, we've seen that our drawdown amongst our basket has been larger than that of the index. But since then and to date, our basket has already managed to recover 47% of that 40.1% drawdown, which is fantastic, and we would hope to see some further momentum going through the year. Now that we have covered equities, where we think there's value in equities, as well as properties, and where we think there's value in property going forward, I think it's important that we continue the discussion about what this fund's mandate is, and why that is the case. So we'll get onto the why in a second, but before we get there, just to give you a brief overview of how we are currently positioned and how we think we're going to be positioned in the foreseeable future. So we are going to aim to have between 40 and 45% of our fund invested directly offshore. The regulation 28 limit is up to 45%, and we feel like we will be very close to that limit at all times. We will have 25 to 35% of the fund invested in Rand hedge equities. We have a limit of 75% that we can have invested in equity securities. And so we are going to be very close to that limit as well, given all the upside that we see from equities over longer periods of time. We're going to have between 15 and 25% invested in listed property companies, and then the remainder in an other basket. Finally, before we move on to the why we are invested in that manner, I think it's important to have a look back at 2022 and how the fund has changed in terms of its geographical composition. The first big thing that you'll see there is that we've been able to increase our direct offshore exposure. I mentioned a little bit earlier that was due to a change which happened in Regulation 28 in 2022, which now increased our limit from 30% to 45%. So we were very happy about that. As Chris mentioned, we see a lot of value offshore, particularly in the States at the moment. And so that was music to our ears. We were delighted to be able to invest more directly offshore. The second big change, which you'll see there, is a decrease in our exposure to China. Not only did we see issues in Chinese equity markets with zero COVID policy and the potential intervention in the functioning of free markets, but at the same time, throughout the course of 2022, we started to see similar upside in our modeling between Chinese securities and American securities. And when that was the case, why take all the extra risk that comes with exposure to China when we see as much upside in the States? So you'll see a big increase in our exposure to America. So finally, onto the why. Why are we positioned in the way we are? You have heard already today the word Rand hedge a lot of the time. If we can look to the chart on the top left-hand side of your screen there, what you'll see is that since 1996, the Rand has depreciated by about 6% per annum against the US dollar. That is consistent. And what we see with our local investors who are invested in this product is that a lot of their hard assets, as well as their income, is earned in rands, and the purchasing power of those rands is depreciating consistently. And so we feel that we've created a product here which has the ability to mitigate some of that risk and mitigate a lot of the South African specific risk that they have to deal with on a daily basis.
And then just moving to the chart on the top right, this is obviously supported by that Rand movement, but you can see that the S&P 500 has outperformed the JSE All Share, this in Rands, by roughly 2.3% per annum since 1996, and by over 2,000% on a total return basis. I think this speaks to the benefits of maximizing your offshore allowance of between 40 and 45%. And yeah, really just add support to the mandate of the fund.
So Chris spoke to maximizing the offshore component of the fund at approximately 45%. But the question is, what do you do with the remaining 55%? So within the local market, we decided that the fund's mandate is to focus on the Rand hedge counters. That's both in the property space and the equity space. Firstly, if I can shift your eyes to the bottom left chart, that shows the performance of the Rand hedge shares within the South African top 40 index relative to the SA focused shares doing business here in South Africa, otherwise termed the SA Inc. shares. You can see that over 1 year, the Rand hedge shares have performed nicely, outperforming quite strongly. It looks very good over a 5-year period, 17.8 versus 4.1 for the South African focus shares. However, you'll notice that over the periods 10 years and 20 years, they performed pretty much in line, and even the SA Inc. shares outperformed the Rand hedge counters over a 20-year period. Why is this so? From the period 2003 through to 2013, the Rand was relatively flat against the US dollar. So the Rand hedge counters didn't benefit from a depreciating currency. But also South Africa was performing very nicely during that period. Commodities were strong. GDP growth was averaged about 3 to 3.5% over the period, and the economy was generally quite strong. What we've seen over the past 10 to 13 years is a slow depreciation in the currency, as you can see on the top left, ultimately leading to Nenegate, and then COVID just exacerbated things. But the trend line is very much constant from bottom left to top right over the past 10 to 13 years. We are very patriotic here at High Street. We really love South Africa, but we feel this is we created this vehicle as a chance for investors to diversify away from South Africa. If you're earning all your money in South Africa, if you have property investments here in South Africa, this gives you an opportunity to externalize your retirement savings to some degree. As such, we do have, and we'll aim to maintain a 95% plus Rand hedge exposure. Just while I'm on it, the chart on the bottom right relates to the property sector. So unfortunately, we only have data going back approximately 5 years, because Rand hedge property counters listed on the local exchange, their track record is relatively limited. However, I think the picture does emerge that the Rand hedge properties over longer periods, say 3 and 5 years, have outperformed the SA property counters to some degree. It has been a poor year. So if you look at the 1-year number, the Rand hedge counters have significantly underperformed those of the SA focused property players. However, as Ross Yammin detailed a little bit earlier, the fundamentals of these property companies in which we are invested remain robust, and they continue to meet management's targets as well as ours. So we do see a re-rating, a potential re-rating to come through for these shares. And liquidity does play a big part in that, as Ross mentioned. So when it comes through, we think it will be pretty severe and pretty sharp. So that takes us to our outlook. When we last presented in June of 2022, we saw inflation as peaking. So inflation has now peaked. It is slowly starting to ease, but we once again would like to emphasize that we are not macroeconomists, and we pay very little attention to the future projections. It is very important to understand why we are here, what has happened over the past year, and how the macroeconomic variables have impacted valuations. So in the short term, valuations may move all over the place. However, in the long term, it's the fundamental metrics that drive equity and listed property prices. COVID in China was still COVID lockdowns in China was still a very real thing. And we saw a lot of stimulus coming through from the Chinese government. It has happened to a certain degree, but the Chinese economy is not out of the woods yet. With an internal GDP target number of 5%, we are a bit skeptical about the accuracy of those numbers, and there are signs that the Chinese economy is still struggling to get back to where it was, particularly because they settled with a lot of debt, especially in their property sector. What's more, this is a retirement fund, and the decision was made to reduce China significantly on the premise that we are not investing in free markets in China. One man controlling 1.3 billion people can, at a stroke of a pen, erase a lot off the market cap of these shares and ultimately of our clients' retirement savings. So that was a decision to reduce China. The Russia-Ukrainian conflict, we are just about a year in, and it shows no signs of ending. However, humans are resilient, and as we've seen, they managed to make do with what they have. So that's why we see inflation expectations coming off, which, as mentioned, will be good for valuations, especially premised on strong underlying fundamentals. I think most notably there is you'll see that the offshore component has increased from 29%. That's the direct offshore component, has increased from 29% going into the year to a current offshore exposure of 42%. And this was in line with the changes in Regulation 28, which Ross spoke to earlier. You also see that South African specific exposure has decreased from 5% down to 3%. So how have we performed year to date? Last year was a very bad year for the fund, especially relative to the benchmark, down 23.6%. You will remember that international equity markets were down 15% and international property markets were down 25%. So the fund is likely, due to its mandate, to perform in line with international markets as opposed to that of South African markets. That said, a return of 23.6% was still very disappointing for us. Year to date, the fund is up 18.1%, being buoyed by, as Ross mentioned, the fundamentals being realized in the valuations, as well as the exchange rate, with the rand weakening some 5-6% to over 18 to the dollar. If we dig into the underlying asset classes on the bottom, you'll see that our offshore equity component was very weak last year, down 41% for the category. Our rand hedge equity, locally listed, was up 3.1%, roughly in line with the local markets, and our property exposure was down 30%. It's been a good showing. Obviously, all of this adds up to the year-to-date performance. Remember, adding the components on the bottom, how do we get to 18.1? They'll be buoyed by a bit of currency, with the currency depreciating by 4 to 5%. So it's been a good start to the year. We still believe in the fund's mandate. We believe that, especially for retirement savers, to maximize your offshore exposure, and within the local component, to maximize your rand hedge exposure, will pay dividends over the longer term. We now open the floor to any Q&A. Okay, first one is, what are the risks on investing in an SA Inc. company? Would you ever consider investing in them? I think I can take that one. Would we ever consider investing in them? No. So the mandate of the fund is to maximize offshore exposure and minimize South African specific risk. So unless that share has a greater than 50% exposure to offshore in terms of its revenue streams, and less than 50% of its asset base here in South Africa, we would not invest. Not to say that the performance of SA Inc. companies cannot once again return significant amounts for investors. What we saw from the period 2003 to 2013 was significant, with the likes of Clicks, RMH, RMI performing significantly well. But where we are in the South African economy, we don't take a view on it. We simply allow investors the opportunity to diversify their portfolio with some offshore exposure.
I think that's the key, is no, we would not ever consider investing in them, because we have tried to create a product here which takes South African specific risk away from them within their savings. This is a retirement product. There are lots of South African specific risks. I think they are all around you. We've seen what's happened in the load shedding situation so far in 2023. But exactly what we're trying to do here is to reduce South African specific risk. And so absolutely not, we would not invest in SA companies.
There's another one. Do you expect the fund's current growth bias to continue in the long term? As a house, one of our fundamental metrics is premised off top line revenue growth, because in the short term, you might get a bit of an unlock due to valuation, but in the longer term, there has to be compounding revenue and ultimately cash flows coming through from 5 years plus that will drive the share price. So we do have a bias towards growth counters. However, we still believe we are a style agnostic house and everything has a price at a certain value. However, strategically, I think the fund's growth bias will remain at about 70 to 80% growth. Meanwhile, 20 to 30% on a value basis, and that value component is largely comprised of the shares which we hold here in South Africa, those rand hedge shares. Many of those are defensive businesses with the top line not growing at significant rates, however, still attractive and in line with the fund's mandate. Ooh, will the rand continue to depreciate? I think that's it's a very difficult one to try and predict where the rand is going to go. The only accurate indicator that we have is the purchasing power of parity, which is basically the Big Mac index. Some of you might have heard of it. So it's the inflation rate differential between the two countries. So if you take in normal times, South Africa's inflation running at 6.5% relative to the US 2 to 2.5%, that implies that the rand should depreciate by 4% per annum. If you plot that back to 1997, when the central bank started setting interest rates on a periodic basis, you'll see that it's consistently followed that long-term trend. However, there are bouts of short-term blowouts that we spoke to earlier, that Chris spoke to earlier, being the global financial crisis, being Nenegate, etc. So relative to where that trend line says the rand dollar should be at, the rand is quite undervalued based on that premise. However, on the upside, I think the rand could appreciate and go to 15, maybe even 14 under Goldilocks scenario. So that's 4 and 18, which is approximately 20 to 25%. On the downside, should something happen in South Africa, which is significant, once again, we don't try and forecast the future here at High Street, but just in terms of positioning, if something drastic was to happen, the rand could blow out to 20, 30, 40, pick a number. But we are not doomsday prophets. Once again, we do not expect that to happen, but we wouldn't rule it out. So, sorry, to sum up there, over the long term, yes, we expect the rand to continue to depreciate. However, in the shorter term periods, over 1 to 3 years even, it's very volatile, and we don't have a view on that. Okay, I think that's it. Thanks very much for listening. I'm glad that we've got the year off to a better start. And thank you for your ongoing support and patience, especially with last year's performance. We will be hosting a presentation every year, and hopefully next year we can do it in person to have a bit more engagement. and hopefully deliver some positive results. Thanks for listening.